Speaking of raising rates, the Federal Reserve just announced it will not raise rates right now. In a statement Wednesday, we learned the Fed is leaving its benchmark interest rate between 1 and 1.25%. The announcement does not come as a surprise. Inflation has been weaker than originally expected, though the Fed believes it'll rebound in the near future. What investors were looking for in this statement was a more precise timeline on when the Fed wants to start downsizing its bond portfolio, which will apparently happen relatively soon. The Fed currently has a $4.5 trillion balance sheet in treasuries and bonds it bought up after the financial crisis. The dollar dropped on the announcement while gold rebounded after sliding most of Wednesday, waiting for news from the Fed. Well, to dig deeper into this announcement and what it'll mean for growth, I'm joined now by Peter Schiff, CEO of Euro-Pacific Capital. Peter, thanks for joining us today. Look, the Fed just released its plan for the next few months, and there was, of course, some things that many people were predicting. One of them is that the interest rates were not going to rise, not going to change. What kind of impact do you think we can expect from this sort of announcement?
Well, no impact. I mean, pretty much everybody knew the Fed was not going to surprise the markets and hike rates this meeting, although they did indicate that they would begin to shrink their balance sheet relatively soon. But by relatively soon, they may mean never. Because, shrinking the balance sheet is a lot harder than expanding it. Quantitative easing was the fun part. Quantitative tightening is not only the hard part, it's really the impossible part. But it is possible that Janet Yellen may, in fact, begin the process, but it's never going to be completed. Long before that day comes, we're going to have to go back to 0% interest rates. The Fed's going to relaunch quantitative easing, QE4. Maybe it won't be Janet Yellen that does it. Maybe it'll be whoever Donald Trump appoints to replace her.
Well, why do you say that we're going to go backwards now? What's pointing toward that happening?
Well, look, the U.S. economy is long overdue for a recession anyway. I mean, this is one of the longest expansions in history. It's certainly the weakest expansion in history, and it's required the most amount of artificial stimulus in history. But look, the economy is slowing down dramatically, even the way we measure it. The consumer is dead. He's loaded up with debt. Retail sales are plunging. We can't be far from a recession. And so what is the Fed going to do in the next recession? They're going to do exactly what they did in the last one. They're going to lower interest rates, and they're going to do quantitative easing.
Do you see a disconnect between what you are saying to us right now and what Janet Yellen is saying in her Federal Reserve statements? She continues to point toward positive things happening in the economy and kind of brushing off things that look a little bit more negative, like this stalled growth.
Yeah, because that's all the Fed ever does. I mean, they're always optimistic. They're always positive. They never acknowledge the problems. Even if they see them, they're not going to admit it. I mean, they were very positive going right into the financial crisis of 2008. I mean, it's like you're a weatherman and there's a Category 5 hurricane right off the coast, and your forecast is sunshine and it's great weather. I mean, that's the Federal Reserve. So they're never going to give you an honest assessment of the economy, even if they honestly understand it. So it doesn't surprise me that the Fed is very sanguine about the future, but the future, unfortunately, is quite bleak, especially as a result of the policies that the Fed has pursued. Because everything that the Federal Reserve has done in the aftermath of the 2008 financial crisis has made the underlying economic problems that caused that crisis worse, and now the Fed has set us up for an even bigger disaster.
One of the takeaways from today's statement really stuck out to me. It seemed pretty counterintuitive. The Fed said it wanted to get economic levels to a point where it neither encourages nor discourages economic activity. Peter, what does that mean?
I don't even know if the Fed knows what that means, because, we want the free market to set interest rates. So if you want an interest rate that is conducive to economic growth, let the market set the rate. When the Fed sets the rate, it's never going to get it right. It's either going to be too high or too low, and in most cases, it's too low. But the interest rate being too low distorts the economy. What it's resulted, or what it's produced, is slow growth because we have minimal capital investment. We don't have enough savings and real production. So we divert resources from Main Street to Wall Street. So we get asset bubbles and we get a weak economy. And that's what we've had.
Well, what would you suggest then? We're talking about a stage right now where it looks like interest rates are going to stay between 1 and 1.25%, probably at least until December. What would you be doing instead at this moment to brace ourselves for what's to come in the next couple of years?
Well, I think the dollar rally that we had in 2014, 2015 was really a sucker rally. It was a bunch of currency traders betting on the efficacy of Fed policy, and I think they bet wrong. And in fact, coming into this year, the most crowded trade on Wall Street was long the dollar. The dollar did rally. The dollar index rallied about 6% between the time Trump was elected and the time he was inaugurated. Well, since inauguration, the dollar index has collapsed about 10%. We're at a new low for the year today, and I think the air is only just starting to come out of this bubble. So I think the dollar is going way down, especially when the Fed has to do an about face. And, you know, Donald Trump basically is daring Janet Yellen to raise rates because he basically is dangling the carrot that he might reappoint her, provided that she keeps interest rates low. Now, I don't think he's going to reappoint her, but I don't know that Yellen is going to take the bait. I mean, maybe she will have to raise rates because she doesn't want to appear to be caving into his pressure. But I don't even think if it matters if the Fed manages 1 or 2 more rate hikes before Janet Yellen leaves office. You know, they're pretty much done. They never really normalized interest rates, so the rate hikes that we're getting are too little too late to help the dollar. It's going down, and what might be a problem is if the dollar really tanks, the trade deficit's going up because Americans are going to have to spend more for their imports, and that rising trade deficit could annoy President Trump because he doesn't like the trade deficit. It is a problem, but he always threatens protectionism, and that could be an even bigger problem.
So the president of the Federal Reserve Bank of Minneapolis, Neil Kashkari, said that the Fed has been raising rates too fast and the next rate hike isn't expected until at least December. So obviously that goes against what you are saying. Is increasing rates quicker something that we should be concerned about? I think you've answered that. But where does that come from, that idea that it was too fast, that we weren't ready when it's been, what, 8-9 years?
Well, they've been, you know, I don't even say that they've been raising them at a snail's pace because I think snails are faster. But, you know, they have certainly accelerated. Ever since Trump was elected, the Fed has hiked rates 3 times. Before the election, during the entire 8 years of Obama, they raised rates just once. So, you know, they have certainly picked up the pace, even though the economy is no stronger and in many cases is weaker now than it was in the years before Trump took office. So I think the Fed has been emboldened to raise rates because they have a fall guy in Donald Trump. I think Donald Trump has made the mistake of claiming ownership of this economy, claiming ownership of the stock market, taking credit for the stock market's gains and the supposed strength of the economy. And so he set himself up perfectly, and the Fed could take advantage of that because when everything comes tumbling down, they can blame it all on Trump.
Peter Schiff, CEO of Euro Pacific Capital. Certainly a pleasure talking to you. Thank you so much.